On a Tuesday morning, the finance manager of a small company opens her banking app and finds 4,000 euros gone, paid to a supplier she has never dealt with. Nothing was hacked, nobody stole her password, and when she calls the bank, they tell her something worse than fraud. That payment was authorized by her. 6 weeks earlier, she had switched on an assistant that pays the invoices for her, and she has not looked at it since. Her story is not rare. It is the shape of modern fraud. The European Banking Authority and the ECB counted 4.2 billion euros of payment fraud across the European Economic Area in 2024. For credit transfers, 74% of that value came from payers who were manipulated into paying it themselves, up from 65%. And those users carried 85% of the losses. So by the end of this, you will know 3 things: what authorized actually means, why a machine breaks it, and the 3 rules teams are writing right now. So, first principles. Under European payment law, a payment is authorized only if the payer consented to it, in a form the 2 of them agreed. No consent, and it is unauthorized. That one word decides everything that follows. If it is unauthorized, Article 73 says your bank refunds you immediately, and no later than the end of the next business day. If it is authorized, that article never opens. You get help chasing the money and nothing more. One word. 2 completely different mornings. Now rewind to our finance manager. Did she consent? She never saw this invoice. She never saw this supplier. What she agreed to 6 weeks ago was a rule. Pay my supplier invoices under 5,000 euros. That is a standing mandate, and the law asks a narrower question than the one she answered. It asks whether she consented to the transaction. She consented to a category, and something else decided what fell into it. That gap did not exist when a human had to press the button, and it is not hypothetical. Visa, MasterCard, Stripe, and OpenAI all shipped agent payment programs last year. Read every one of those announcements, and the same thing is missing. Not one says who pays when the agent gets it wrong. Here is what a smart, busy banker says at this point. Relax. Europe has regulated machines that move money for years. It is called algorithmic trading. And that is true. Article 17 of MiFID II and the technical standard underneath it demand tested algorithms, a separate test environment, pre-trade limits, and a kill switch that cancels every open order at once. Here is the catch. That rulebook only bites when a firm is trading financial instruments, shares, bonds, derivatives. It does not reach the assistant that paid our 4,000 euro invoice. Same technology, same blast radius, different legal universe. And we know what happens when those controls are missing, because it has already happened. On the 1st of August 2012, a trading firm called Knight Capital pushed new code to 8 servers. A technician missed one. Nobody reviewed the deployment because no written rule said anyone had to. 97 warning emails fired before the market even opened, and nobody acted on one of them. 45 minutes later, the firm had lost more than $460 million. That is the SEC's own number. And that code was deterministic. You could read it line by line and predict it. Nobody can do that with the assistant on our finance manager's account. So who is liable when the agent gets it wrong? Search the public record and you will not find out. No enforcement action, no judgment, no disclosure of an AI agent at a bank or a payment firm releasing a payment it should not have. It has not happened publicly yet. The closest documented case is a crypto prize game, where somebody talked an AI agent into releasing a $47,000 pot it was told to keep. The nearest thing to a ruling is a small claims tribunal in Canada, where an airline argued its chatbot was a separate legal entity, responsible for its own actions. The tribunal called that remarkable and made the airline pay. Our finance manager has no case to point at. Neither does her bank. You do not have to take my word for the gap. On the 30th of June this year, the Deputy Governor of the Bank of England stood up at the European Central Bank's forum and said this. She then listed exactly what is unsettled, how users give consent to agents, especially for multiple transactions, how disputes get settled, and how liability is assigned for erroneous or fraudulent transactions. That is a central banker saying the machinery does not exist yet. So what about the AI Act? Here is the part most people get wrong. Search the whole high-risk annex and you find exactly two financial services entries: credit scoring of individuals and risk pricing for life and health insurance. That is it. Fraud detection is written out of the credit scoring entry by name. Payments appear nowhere. An AI that moves your money is not high risk under this law. An AI that decides whether you get the loan is. Her invoice assistant sits outside that tier completely. And those high-risk duties just moved anyway, back to December 2027. The transparency rule kept its date. But do not mistake a gap in one rulebook for a gap in all of them. DORA has applied since January 2025, and it says the management body bears ultimate responsibility for managing the firm's technology risk. A firm stays fully responsible even when it hands the work to somebody else. And in June, the Financial Stability Board consulted on 12 sound practices for AI. Not binding, it says so itself. But one line lands: even when the monitoring is done by machines, institutions and individuals retain ultimate accountability. So there is no rule that names AI agents. There is also no rule that lets you point at one. So here is the test teams are already applying. 1. A bounded mandate. The agent gets a payment limit, a list of counterparties it is allowed to pay, and an expiry date. Not pay my invoices. 2. Evidence that reconstructs the decision. Log the instruction, the reasoning, the approval, and the release, so that months later somebody can say who decided and then prove it. 3. A stop that somebody has actually pulled, not a switch on a slide. A tested one with a named owner and a date on the last test. Run our Tuesday morning again with those 3 rules switched on. The €4,000 invoice hits a per payment limit of 1,000. The supplier is not on the approved list, so it does not go out. It queues and it waits for a human. She sees it at 9 and the money never leaves, which gives us the takeaway. Authorization was never really about the click. It was about somebody being able to say afterwards, I decided that, and prove it. Keep that sentence true and the rest is engineering. If that was useful, subscribe, because this question is going to get louder. The free RegAI brief newsletter is linked below if you want these in writing. And one question before you go, because I read every answer. Would you let an agent release a payment with no human at all? And if yes, what is your limit?